I think we'll start. Good morning, everyone. Welcome to the OFX webinar. My name is Michael Judge, and I'm the Head of Australia and New Zealand here at OFX. I'm responsible for its core consumer and corporate businesses across both Oz and NZ. Very excited and delighted to also be welcoming one of OFX's proud partners, the CPA of Australia. And on the line with me this morning, I do have Eleanor Cassipedes. Eleanor is the tax policy advisor with the CPA. Eleanor is responsible for the development of policy, research and advocacy on issues related to tax policy, legislation and administration in Australia and around the world. Eleanor does lead the CPA of Australia's Taxation Centre of Excellence and represents CPA Australia on a variety of tax-related issues. I'm conscious that some people in the audience today are obviously new to OFX. They are also new to the organisation of the CPA. So by way of introduction, certainly as OFX was a business which was founded 20 years ago, and it basically did grow from the concept that there had to be a better, fairer way to move money around the world. Obviously, since 1998, 22 odd years have now passed. Our role today is still very much the same. We do seek to help businesses and consumers remove the complexity, the cost, and so often the anxiety which is associated with sending and receiving funds globally. Today, we are a global business and we do operate across the world. We have a local presence in 7 key markets, and we do offer our customers the best of both worlds. That is a seamless digital platform combined with 24/7 phone access to our currency experts. CPA Australia, as I mentioned, a proud sponsor, I should say proud partner of OFX, one of the world's largest accounting bodies with a global membership of more than 165,000 members working over 100 countries and regions around the world. So obviously to start things off this morning, look, I think one of the key things which we do wanted to cover is obviously the global market and financial markets of today. The reality being that the market that we find ourselves in today is uniquely different and in fact vastly different to the markets that we were observing and the markets that were operating through at the beginning of 2020. So firstly, we will embed ourselves and entrench ourselves against the markets of today. I think it's really important for a lot of businesses who are operating in global currency markets to be situationally aware of some of the things that obviously passed under the bridge and equally some of the things which are driving markets for the rest of 2020. So we're going to spend a fair bit of time again speaking around what we're observing and equally what our expectations are for the back half of 2020. Once we've covered and embedded ourselves against today's market, we're going to move through to a bit of an assessment over how businesses can operate and how businesses can frankly mitigate some of the heightened levels of risk they are facing in this volatile and uncertain market. And in the second half of today's webinar, again, I will be introducing you to Eleanor from the CPA, and one of her key discussion points will be around the government's response to the COVID-19 pandemic, as well as talking about some of the common and current tax issues facing businesses, and in particular facing businesses who are, again, sending and receiving funds globally. So first things first, I think it's really important for a lot of businesses to, again, have a heightened level of awareness around what is happening in the markets of today. Now, the reality is that currency considerations and the role exchange rates can play in businesses are often viewed as a secondary, if not a peripheral consideration for a lot of organisations. But again, the reality is when you move into very volatile markets, often some heightened levels of risk can surface. So what I wanted to do is kind of talk about, I suppose, a couple of the key pillars that we are often speaking about and often some of the key pillars that we're also looking towards for the back half of 2020. And where I am going to start is with the word of volatility, and I suppose an assessment that today's market is incredibly uncertain. For a lot of businesses that have been operating in FX markets for an extended period, you've probably become accustomed to the word of volatility being used very frequently. But I think in a more realistic sense, there's probably a suggestion to say that the terms of volatility and uncertainty have probably been often used, particularly throughout the course of 2018 and 2019, which is to say, up until the beginning of 2020, there is an argument to suggest that markets were acting relatively rationally, and there was a degree of practicality involved in how they were functioning. For a lot of businesses who had Kiwi exposures or Australian dollar exposures, by example, a lot of those currency corridors were performing in a well-entrenched trend. There was fundamental drivers which were dictating their longer-term values, which is to say, throughout 2018 and again throughout 2019 as well, the Australian dollar in particular was entrenched in a well-controlled declining trend. We saw year-on-year downside movement and downside bias, which essentially didn't let up for a 24-month stretch. That trend was still well established when we entered into the beginning of 2020. And one thing which is always observable in how we view exchange rates over the longer term is how interest rate movements obviously play a role. Now, throughout the course of 2018 and 2019, again, with the fact that interest rates in Australia were relatively neutral, and if not, they were favoured towards a decline, versus our US friends, and again, versus the US Federal Reserve, where of course we were expecting a path to normalisation and higher rates in a shorter time frame. Where we arrived, I suppose, in March is obviously the COVID-19 pandemic. And again, the dynamic of the global backdrop has changed profoundly. If there was a view to say that markets were acting, I suppose, rationally and in a relatively controlled manner up until that point in time, essentially that playbook did get torn up to some extent in the middle of March of this year. So this is where the words of volatility, uncertainty, I suppose, are, in some extent, they're used in the right context. That we saw a first wave of sell-off across all global markets. We saw a profound impact across currency markets. We saw big asset and value distortions in equity markets as well. And that first wave of response was very much fear-led. What we did see is obviously all funds globally basically pivot towards some of the world's deepest and safest havens. So again, what that meant for currencies like the Australian dollar is they were sold across the board. We saw the Aussie US in particular, it crashed to a level of 55 US cents. And really, that was evidence across the spectrum. It was well and truly a herd mentality and a fear-led response. Since the COVID-19 pandemic first took impact in mid-March, that second phase in markets has obviously been led by interest rates, and it's often been led by the response of global banks and global governments around the world. We have seen an unheralded response from central banks. Locally, the RBA has obviously cut interest rates by 5 times in the last 12 months. We saw 2 emergency cuts in particular at the heart of the pandemic. In some parts of the world, by example, we've actually seen negative interest rates instilled. And Japan and Europe, there's clear evidence of that. We've also seen a profound response from governments. So from a fiscal response, obviously we have seen markets incredibly well supported from a liquidity perspective. And what that has meant is that the recovery that we've seen from March through to today, it has been incredibly entrenched and incredibly well supported by the acts of central banks and frankly by the acts of governments around the world. It's in the times of distress and the times of volatility that, again, central banks and governments have done a really big role, or played, I should say, a very big role in obviously leading the recovery that we've obviously since observed. So it leads us to where we are today. And again, I said we are in a position now where frankly volatility and uncertainty is certainly going to be a big maker of the second half of 2020 and beyond. A lot of the recoveries that we've seen in currency markets and a lot of the recovery that we've seen across global markets, again, they haven't necessarily been fueled by economic fundamentals. it has been fueled by the liquidity support in the main, again, of central banks and global governments. And as a result, we are seeing an added role of market sentiment. Again, which is to say markets have been really well supported, there's heightened levels of liquidity, and at the moment, we are starting to see a whole heap of optimistic sentiment creep into markets. And as a result, underlying risks when investors and market participants are making decisions, I think there's fair assumption to say that risk isn't being adequately priced at the moment. And that comes back to the fact of the level of support in which is basically part of the environment. So I would say today, again, volatility is frankly, I think it's fair to say it's going to be here for a significant period. Market sentiment's playing an added role in terms of where valuations sit from a currency and equity perspective. And I think finally, the geopolitical unrest and trade tensions across some of the world's biggest markets are playing a very big role. It is becoming increasingly evident that the likes of US, Australia, and China, obviously becoming, I suppose, increasingly challenging to observe an open exit door in terms of how these trade tensions are going to end. All of these things are playing a really big role. And again, I started a commentary around today's marketplace and a heightened levels of awareness and a heightened levels of situational awareness. And this will all come back into a lot more context when we shortly talk about currency risk management and the importance of mitigating some of the ugly edges which may well surface. So I'm just going to move on to the next slide here. And basically what we have here is an illustration, again, over that narrative which is kind of played out, particularly for the Aussie-US and the Kiwi-US pairs. The types of volatility that we've observed between March this year and August of today, essentially, it does represent the type of volatility you would frankly expect over a period of up to 24 months. Types of currency ranges and the types of markets, their underlying behavior is incredibly unique. And for a lot of businesses, the reality is they haven't been forced to operate through this level of volatility before. So again, we can really see, I suppose, the trajectory of the Australian dollar and equally the trajectory of the Kiwi over a very short period of time. So the natural question from here is where to next for the Aussie? And I think if we jump to the next slide, again, what we are really looking for the Aussie-US in particular are 4 key points. Again, I've already talked about the role of market sentiment and the fact that risk at the moment isn't necessarily being adequately priced. The reality of the Australian dollar, again, is that it is typically very sensitive and it always has been viewed as a barometer to global risk sentiment. So in an environment where risk is being taken on in quite large volumes by market participants, again, the Australian dollar will benefit from that. We've seen the Australian dollar as well, often termed the commodity currency. The Australian economy broadly is a small open economy, yet the Australian dollar is the world's 5th most largest traded currency. And the reason for that, again, is that we have a high demand and a rich supply, frankly, of raw materials. So what that means is that commodity prices and the value of the Australian dollar are often highly correlated. And what we can see on this graph is obviously how the Australian dollar moves along with iron ore, as well as along with interest rate differentials as well. But iron ore prices and underlying raw material prices, frankly, they do matter. And again, if you were to monitor, for example, the price of iron ore, or even say the price of copper, you would be able to distinguishably see a high level of correlation between both the price of the commodity versus the price of the value of the currency. And at the moment, obviously, given they do remain at elevated prices, again, that has really played a pivotal role in supporting the AUD. I've talked a little bit around from a fundamental perspective and more so from a longer term perspective, the role of interest rates. Now, again, typically if interest rates in Australia sit above that of the US, that's going to provide a tailwind for the Australian dollar. Investors globally will be looking to buy the AUD. They'll be looking to store assets and store cash or cash equivalent in Australian dollar terms because there's zero risk reward in earning high yields for Australian dollar denominations. Finally, what's unique about this environment is the role the US dollar is playing. Now, when you look at the AUD and USD cross in particular, the Australian dollar value always should be viewed in a relative sense, which is to say, at the moment, the greenback, the world's reserve currency, it sits at a 2-year low. It has been sold off quite aggressively over the course of the last 4 to 5 months. And that greenback weakness is again propelling and supporting the AUD as well. So in terms of what the next 6 months looks like, look, I don't think the risk on environment, iron ore prices, or frankly, the role of the US dollar is going to change. I think those 3 pieces are going to be very important in obviously dictating future direction of the AUD. I do think as well that from a directional perspective, again, one thing we are really watching is this relative story. Again, which is to say that we know there's some economic pain which is expected from the Australian economy. We know there's some economic pain expected from a North America perspective as well. But from a relative assessment, again, there could be a case to suggest we are better prepared from a societal perspective and an economic perspective to recover from the current COVID-19 conditions. So all in all, again, I think the outlook for the Australian dollar is looking relatively positive, but overall profoundly different to what it was, in fact, looking like at the beginning of 2020. So we're going to change tack slightly now. Again, we've talked a fair bit about markets already, but the reality is of what we're watching are those 3 particular things. We will keep an eye on commodity prices, we'll keep an eye on US dollar weakness, and of course, again, it remains a story of, it does remain a story dictated by market sentiment. In terms of what we are watching as well, in this environment, the reason why we do label it to be an environment of added uncertainty and added, I suppose, volatility comes back to a recognition, I suppose, that at the moment there is a disconnect between fundamental behaviour and obviously the role of sentiment. And typically, when you see a response in markets led by the response of our governments and the response of our central banks, typically you will see a trend over amplified, and we have again seen markets overshoot in either which direction. And for the direction of the Aussie, again, it's overshot to the upside. Assets, valuations, currencies, and the Australian dollar included, they are all now at positions above where we were at the beginning of the COVID-19. So again, there's probably an argument to suggest we have overshot in the near term. We are watching the US dollar, and again, from a geopolitical perspective, there is obviously a lot of discourse still and a lot of conversations happening in UK and Europe around Brexit. There'll be opportunities, I should have actually mentioned at the beginning of the webinar, to ask any questions. And again, we often do get a lot of questions around what we're seeing in the market, and equally, we are more than happy to keep our customers informed and our prospects informed as well in terms of what we are observing. So if you've got any questions, Steph Doyle, who's also on the call today, she'll be facilitating a little bit of a Q&A towards the back half. All right, so we're going to move along now, and we're going to talk about, I suppose, not markets, but we're going to talk about some very simple tips and some very basic frameworks that some businesses can start to consider when they're looking to remove, mitigate, or manage currency risk. I mentioned earlier that a lot of the businesses will often view currency risk as a secondary consideration. There are a whole heap of variables that importers and exporters need to, I suppose, navigate. And again, exchange rate fluctuations is often something which is left to be a latter consideration. And again, unfortunately, what we did observe in the early phases of the COVID-19 response is that demand for hedging products did increase substantially. And we did see a little bit of an emotional-led response and absolutely a reactionary response to what was happening in the market at that particular point in time. But again, the importance of being really well planned and really well considered in terms of FX risk management is to make sure that your decisions are more led off the back of a simple or basic currency plan versus being led solely off what's happening in the market at any particular point in time. We're going to talk quite a little bit about the importance of having a basic currency plan or basic currency framework, just so businesses can be really well supported and be a little bit more informed when they are forced to navigate or make currency choices through volatile markets. So typically, the logical place to start when we talk about currency risk management is to understand what is FX risk. And what this graph shows is an exchange rate movement in a very short period of time. And it also shows a currency exchange movement against a very small parcel of currency. So between the 6th of January 2020 versus April 2020, again, if you were an importer purchasing $20,000 worth of US dollars, the additional cost of transacting in April versus transacting in January, what would have been to the value of close to 3,400 Aussie dollars. So FX risk in simple terms refers to the losses that an international transfer or transaction may incur due to fluctuations in two different currencies. And again, for businesses who are operating, for businesses who are being exposed frequently, or businesses which are being exposed for larger parcels of currency, again, currency risk management can become increasingly complex, but equally risk can also become quite elevated. So firstly, some key considerations in putting forward a risk management framework, if we want to call it as such. We've talked about what FX risk is, but then again, it does come down to businesses, I suppose, understanding some of the types of risk that they do face. So in providing some examples over the types of risks some businesses face. For an importer and exporter, the most basic form of risk is at a transactional level. Now, I'll give the example of an Australian-based importer. They've got a container arriving in 90 days' time. It's to the value of 100,000 US dollars. On day one, they receive an invoice. There may well be a deposit due in 30 days. And they may well have the full value or the remaining value of that invoice not due until the goods land in 90 days' time. In that circumstance, it's transactional-based risk. The risk is defined by a fixed term, be it 90 days. The risk is also defined by the total size of the exposure, be it 100,000 US dollars. For a business which navigates through the spot market and basically has no underlying risk management approach to that transaction, again, they are exposed to the spot market between day 1 and day 90. If they were to be exposed in that 90-day period between, again, let's say January 2020 and April 2020, that previous slide illustrates the monetary risk that business faces on a smaller parcel only of $20,000. But again, transaction risk is something that can be managed. And frankly, there are a range of different approaches and a range of different products which can help reduce a defined risk over a short period. And we'll talk about those shortly. In a more complex sense, and what we will often have conversations with about customers is around a more economic form of risk. And again, typically exporters or importers as well, they will face transactional-based risks time and time again. They may well have an open order book of 6 or 7 orders. And again, they are re-entering orders on a weekly basis. In that type of environment, obviously, there's added complexities. In that type of context as well, importers and exporters might actually be navigating different currency risks across different markets. They might have different requirements. And again, the complexity adds up and it can become quite overwhelming to manage. So again, once you've understood the types of risks, and I've only really spoken about 2 the reality is we can help a lot of customers, surface some of those types of risks they do face, and frankly, there are quite a few. But again, understand the types of risks you do face. Once you've done that, we'll also talk about the importance of understanding, I suppose your own, overarching risk profile. What is your risk profile in a personal sense and in a business sense as well? If we skip to the next slide, obviously across the spectrum over whether you are risk adverse or, frankly, are you, I suppose, quite intolerant to risk. There are a lot of businesses inherently which will operate very conservatively. They will make conservative and conscious decisions across a whole heap of different business decisions. And that should obviously naturally overarch the currency risk assessments as well. Versus, I suppose, some other industries or some other mindsets where there may well be the ability for high degrees of participation, lower risk practices, and as a result, again, you may well be operating on a higher tolerance spectrum. But again, understand the types of risks you face, understand your own, I suppose, risk profile as well. Typically, when you've done both of those things, again, we will move beyond a basic understanding of risk, and we'll move beyond an assessment of your own appetite. And from there, it's really important to start setting some objectives. Now, again, I mentioned briefly before the importance of a risk management framework is that ultimately your success should be defined against what your outcomes look like against your objectives. Success isn't judged by whether you're beating the market. Success isn't judged by an exchange rate outcome on a transactional level. But a success essentially is around being quite methodical and being very well considered and thought out against your objectives. And success at the end of a period, be it a month, a quarter, or a calendar or financial year, success should be judged against whether you've achieved your objectives or hopefully actually exceeded some of those objectives from a currency point of view. So when setting some objectives, what we will typically say is, again, ask yourself some big questions. And I'm really hoping that, for businesses today that haven't actually asked themselves these questions, that you can walk away from today's webinar and start to consider some of these things for yourself. But really, look, ask yourself some big questions. If you are an importer and exporter which has a defined level of exposure or estimated level of exposure, what are you actually looking to achieve? What are your current operating margins? So again, are you a business which is fortunate enough to have a limited amount of competitions, which might well have, again, operating margins of 45, 65%, versus, I suppose, a business which operates with hyper competitiveness, very tight margins, and again, frankly, the risk in that type of environment of doing nothing is obviously heightened. Understanding your competitive intensity, understanding your competitive environment, all of these things at an aggregated level, they do matter. And finally, it does come to a point of understanding what are the consequences of your exposure. Over the course of time, a number of businesses, they have been financially exposed, frankly, from a lack of currency risk consideration. If you understand the worst case provisions of essentially doing nothing or essentially getting currency choices wrong, what does that look like for you as an organization? Is that going to mean margin compression? Is that going to lead to financial instability? Is it going to lead to fluctuating earnings? And the other thing to consider equally as well is what's that going to do from your, I suppose, domestic competitiveness point of view? And what I mean by that is if you are up against a competitive landscape, which is either actively hedging or being quite passive in their hedging considerations versus somebody who is doing nothing, then obviously a business who is making optimal currency choices is going to have a lot more flexibility in how they price. And naturally, that's going to create a competitive advantage. So again, objectives can look and feel vastly different based on, you know, the dynamic of your own business and equally the dynamic over your own competitive landscape. But again, we can help, I suppose, thrash out some objectives which might be right for your organisation. So what we're going to do, we're going to talk about two basic objectives. And these objectives, they're quite common. And these are some of the things which we do see in a real life sense with a lot of businesses. So by giving, I suppose, line of sight over two common objectives, one of the first objectives is to set a target rate. So again, over the course of a transaction, over the course of a quarter, over the course of a calendar or financial year, you may be entering into a new period of time, and you may actually look to seek or set out a minimum baseline or a minimum target rate that you want to achieve from a currency perspective. If you are an Australian importer, for example, and you've got a defined US cost base, and again, let's say you're an importer which has US $1 million worth of exposure over the course of the year. What you may seek to achieve is an exchange rate above 70 US cents for the full course of a 12-month period. If you actually set that target rate in your own business model, what that will essentially allow is a whole heap of financial assumptions to be, I suppose, baselined against that target rate. It does create certainty and it does set, I suppose, a defined Australian dollar cost for that US dollar exposure on day one. Once you've set a target rate, also it can set the course for conversations around product usage. What types of products are going to help you achieve, or what types of products are going to help you defend against that targeted rate? And again, working with a currency partner or a currency specialist can really help you thrash out what best products are fit for purpose in achieving that target rate. So again, a target rate might be, again, for a full calendar year, a target rate might simply be against a set transaction. But again, the reality is with all currency plans and all business provisioning, it is really important to come back to review whether your target rates are fit for purpose. So again, target rates, it's quite a simple piece to kind of elevate within your business. Again, setting target rates is about creating certainty. It's not necessarily around setting unrealistic target rates or setting target rates above current levels. Very common or very similar to a target rate objectives to set a break-even rate. Again, which is to say, at what exchange rate level can you achieve a profit margin? At what exchange rate level are you going to start observing losses? At what exchange rate level are you going to become uncompetitive against your competitors? So you can in fact look at a target rate almost from the lens of a break-even rate. Predominantly target rates are set to achieve minimal levels of financial performance or minimum levels of financial stability. So look, outside of target rates or break-even rates, they're very similar. Something that can be used in conjunction with that type of approach is to define or set a hedge ratio within your known level of exposure. I'll use the same example. If you're an Australian importer and you've got $1 million worth of US exposure over the course of 12 months, if you, by example, were looking to achieve a targeted rate over 12 months of 70 US cents, one way to achieve that would be to look at a hedge ratio, which is to say at the beginning of your tax or your calendar year, what percentage of that known exposure are you going to hedge in order to defend or achieve that targeted rate? If, by example, you're an importer which adopts a 60-40 hedge ratio, what that means is that you are going to hedge actively 60% of your known FX exposure. That means you are going to set 60% of your exposure at a defined exchange rate. So what that does, it creates two things. It creates certainty for a known percentage of your exposure, whilst at the same time allowing participation, and some risk for the remaining 40% of that exposure. So again, what that does is it allows for participation if the spot market moves in your favor, but equally, it does allow some protection if it does drop below your target rate. Now, typically a hedge ratio, again, it can be used in conjunction with that objective of having a target rate. It doesn't need to be an either or type of conversation. But what we typically will see is that if you are an importer and if you're in an environment like we were, say, in 2018 and 2019, if you are in an environment where the AUD fundamentally is in decline, then typically you may well see hedge ratios increase when the AUD is in decline. But equally, again, for an exporter, that's operating in an environment where the Aussie is rising, again, typically the same can be said. Okay, so what we will typically consider is once a business understands, again, types of risks, once a business understands their broader tolerance to operating with it or eliminating it. Again, objectives are very important. Objectives, again, they should set the course over what good looks like on an ongoing basis. Once you've kind of got those three elements, I wouldn't say embedded, but once you've given those three elements some deep consideration, again, typically the conversation will typically lend itself to what types of products or what set of products or combination of products can help you as an organization achieve those currency objectives. Now, again, like all currency choices and often like a lot of investment decisions, it doesn't need to be a conversation over everything's going to be done at spot versus everything's going to be done using, let's say a forward exchange contract. Typically, optimal outcomes over the longer term can be achieved using a mix of different products. And again, partnering with a specialist, they can actually help you talk through the advantages and the disadvantages, and equally the risks of under or overutilizing set products. But again, for businesses which are starting from scratch or starting from, I suppose, an over dependency on the spot market, typically what we would suggest is start relatively conservative and start to get a really good feel over how some of these products work in a practical sense for smaller parcels of exposure to start with. But I think, again, money transfer options which are available through OFX, they do include a combination of transfers, limit orders, and forward contracts. Now, for a lot of smaller businesses, they typically might think that things like limit orders and forward exchange contracts are saved for more complex scenarios or for more complex levels of exposure. But again, the reality is these products are very available. They're quite simple to use. They're available both digitally and offline as well. And again, partnering with an FX specialist, again, people can talk you through the ins and outs quite intimately. But just to give a brief run through, I suppose transfers, again, they have to book a rate today and transfer the funds today. So it's a spot exchange rate being used. Limit orders aren't too different. Again, what limit orders allow is for a business to nominate a target exchange rate. OFX will watch that exchange rate and they will trigger it for a defined amount of currency if and when it's achieved. So again, using a live example, if the Aussie US, if you were targeting a rate of say 72.50, you may well typically see added volume and added volatility in an overnight session. If you wanted to capture that little spike in the market, if it were to occur, then you could set a limit order in today's environment and we'll do the watching and waiting for you. We'll also obviously automate the execution and notification to you as well. Forward exchange contracts, again, a very common product, and obviously there are a lot of advantages in using forward exchange contracts. They do allow businesses to secure an exchange rate today for a known amount of currency today for a future defined settlement date. So again, if you're an importer and you've got an invoice due in 90 days time for an invoice received today, you may well choose to secure a forward exchange contract at today's rate for settlement in 90 days time. And in that circumstance, you are securing an exchange rate for the full value of that exposure for the full term of that invoice settlement date. And again, a mix of spot and forward could be used simply at a transactional level against that said example. In terms of money transfer options, again, I've already spoken a little bit about the need to be situationally aware. And again, there are quite a few currency management tools available, be it rate alerts, the OFX app, as well as daily and weekly commentary. So remaining relatively well informed. Okay, but before I do pass over to Eleanor, again, I think in summary, just want to baseline the conversation against a couple of items, again, which is to say, it is really important to have a very basic framework or a very basic architecture to help you make informed currency decisions. Understand your risks, set some objectives, and then ultimately partner with somebody which can help you talk through the different products and tools available. What that will essentially enable is businesses to make rational decisions. What we still too often observe is emotional or market-led decisions, and that was really evidenced somewhat unfortunately in March again. We see a real herd mentality and a real emotional-led currency choices when markets become volatile. So if you can plan ahead, you can have a simple currency plan, and things do start to get a little bit choppy, things do start to get a little bit volatile, you'll at least have a plan to baseline your decisions against. I've talked about it already as well, but again, the importance of being situationally aware. The third tip that I've basically put down here is an acknowledgement that time is your friend. When we talk about currency risk management, the ultimate goal is essentially to avoid some of the nasty edges in the market. The ultimate goal is to smooth out some of the fluctuations that we do see over the course of a set period. But ultimately, decisions will often be made for a really big period of time on one particular day. So very often importers and exporters, what they will typically do is they'll say, oh, wow, I've got an exposure for 90 days. I am going to basically narrow my level of exposure and hedge everything for one parcel of currency on one particular day at one particular point in time. But again, the reality is, if you want to smooth out your currency outcomes, you want to use the full value of time. And again, if you want to smooth it out over a truly longer term fundamental view, over the course of 12 months, if the Aussie US was to vary between 55 US cents up to say 75 US cents, if you had an active hedging strategy in place, an optimal outcome may well be that your average rate over time may look something like 65 or 68 US cents. Again, which is to say you are in effect removing all of the bottom side risk below that smoothing or targeted rate, and at the same time giving up some of that top side participation. But there is absolute value, again, in using the full value of that time to your advantage. Look, I think finally, I'm conscious of time. My final little soundbite would be to say that, currency risk management is not a perfect science. Sit down regularly, whether it be weekly, monthly, quarterly, again, and review and refine. It certainly isn't, again, a perfect science. Okay, I'm very, very mindful of time. What I'm going to do now, again, I'll briefly introduce Eleanor from the CPA. She's going to talk you through a few observations from her side, and then we'll circle back for some Q&A.
Thanks, Michael, and hello, everybody. So I think that the final tips that Michael just went through are actually a really good segue. While the links between tax and currency may not be too clear, I think the whole approach to knowing your environment, planning ahead, and reassessing your position, often at the end of the financial year, is a good way to approach this kind of thinking around tax and business assessment. COVID-19 has actually brought a whole lot of challenges to businesses, and it was something that obviously was not anticipated. So many businesses have been scrambling to deal with their situation, the impacts of COVID-19, the economic fallout that has arisen, and some of the supply chain disruptions that have occurred. So in that sense, the governments of New Zealand and Australia and around the world as well have also come to the party. So what they have been doing is designing a range of policies to support employers and businesses to maintain some form of cash flow, some form of economic activity. And the idea is that some operations may be mothballed, some may pivot, some may need to reevaluate their position, but the idea is to provide a cushion. So to manage some of that risk in order to come out of this in a healthier position than what would otherwise have occurred. So the most recent economic stimulus measures that have come out of Australia include the JobKeeper, Cash Flow Boost, SME Guarantee Scheme, as well as a range of state government grants and payments. There are also incentives to invest in capital, and while some businesses obviously have experienced cash flow crunches, there are others that are looking for opportunities or may actually need to invest in new assets in order to pivot to a new operating model or into new markets. We have also in Australia introduced some insolvent trading protections. So once again, that recognises the impact of cash flow on the potential insolvency and has just again provided a bit of a cushion for businesses. New Zealand has actually come out with a range of support measures as well, which are really dynamic. So things like the wage extension, consultancy support, cash flow loans, finance guarantee scheme, and one from a tax perspective, which I find quite interesting, is the temporary tax carryback. So rather than carrying forward losses, you can actually carry them back. And all of that, again, is trying to smooth out the impacts of COVID-19 and to see how businesses can just survive this period, actually undertake some investment, maintain connection with their employees, and come out of this in a position where they can regroup and perhaps be stronger, hopefully, than they were before. When it does come to international trade, what our members have been telling us, so we operate in New Zealand, our members operate in New Zealand, in Australia, and across the world, with many members in Asia as well. A lot of businesses have actually expanded their market. They've looked offshore. They've looked for new products, perhaps, to import or to supply. And so international trade is being seen, especially with the introduction of greater digital capability, as a new market and a new opportunity for businesses. And so for some, the issues around Forex, exposures, currency trading can be quite foreign and quite daunting, but it is something that's going to become increasingly part of the global business environment. And it's a good thing. If our businesses in New Zealand and Australia as small, open economies start to engage more and more with the larger markets overseas, which have greater populations and greater access to, their income, their disposable income, their knowledge and their consumer base, that's a good thing for our respective economies. So in Australia, there are a range of, we have capital gains tax, so there are a range, depending on if you're on revenue or capital account, a range of tax impacts. By and large, if you're trading, regardless of the currency that you're using, you convert it to Australian dollars for tax. And so the ATO, the Australian Taxation Office, publishes daily and monthly foreign exchange rates so that you can just do a little bit like a spot transaction, I guess. You just convert it to whatever the value is in Australian dollars for that particular day. Where you do actually hold assets or balances or exposures in foreign currencies, there are these things called Forex realisation events, and they're contained within the Income Tax Assessment Act 1997, and this is where we recommend professional advisors get involved. So that businesses can focus on their business, you can think about your long-term strategies, your long-term plans. The value of a professional advisor is that they can think through the detail of what your decisions will mean from a tax perspective, for example. Our members also do business advisory, they do audits, they do reporting, so they can actually provide that full service, whether it's in relation to your broader business or in relation to foreign exchange and taxes, just so that you're clear on what the consequences of having those exposures is. In Australia, we do have a $250,000 balance election for foreign denominated accounts. Essentially what this means is that if you have a small balance, a relatively small balance of foreign exchange or foreign currencies, the fluctuations essentially are netted out. You don't necessarily need to have them reported and pay tax on them. What that means is any upside gain you don't have to pay tax on, but also your downside losses also don't get claimed. When you're also operating in foreign jurisdictions or you may be transacting, there are foreign income tax offsets available. So what you might find is, depending on the structure of your operations, how you actually trade and manage your global supply chains or retail operations, you may be able to access foreign income tax offsets, which means that tax that you paid overseas can actually be offset against the tax that you're required to pay in Australia. In New Zealand, slightly different because there's no capital gains tax regime. However, foreign exchange gains and losses are actually brought to account. So they're seen as financial arrangements and they are actually subject to income tax. So that is something that the New Zealand regime does look at. Gains are assessable and losses are deductible subject to certain criteria. And New Zealand also has a foreign tax credit regime. So again, it's not so much about complexity. So a lot of these terms and a lot of these ideas might seem quite complicated, but with an advisor, they can talk you through it. If you keep your good records, you keep your accounts in order, you know when events are happening, that makes it a lot easier at the end of each financial year for your accountant to go through your books and actually be able to report correctly and get your tax liabilities up to date and correct. So make sure that they're tailored to your facts and circumstances, and there are always opportunities to better understand the legislation, to better understand your obligations through a conversation with your advisor. And just broadly, Michael opened up with the uncertainty and the volatility and the impacts of COVID-19, and I don't think any of us are strangers to what's going on. New Zealand has experienced another shutdown. I'm located in Victoria, Australia, so we're currently going through stage 4 restrictions where businesses can't even open at the moment. So while this is quite traumatic for many business owners, and it's been a huge shock the extent to which these shutdowns have changed the way that they operate, CPA Australia has also produced a range of resources under the theme of reflect, reimagine and reinvent. Sometimes a crisis is not a great time to make emotional decisions, but it is an opportunity to take a step back, look at what the future might bring, and to actually undertake an assessment or an evaluation of the business to see what might be able to be achieved under a different set of circumstances. So CPA Australia and our members provide a range of materials and resources in relation to business performance, so looking at your strategies, how you measure your performance, how you structure your organisation, how you set a culture and a value proposition for both your customers and your employees that puts you in a good place in terms of communicating and engaging with them. Business evaluation is something that, as an accounting body, we believe should be done quite often. You should be looking at cash flow all the time. You should look at your profit line. It's not all about revenue growth, it's also about your profitability. Where there are opportunities to identify efficiencies, and I do think this does link back to managing your currency exposures and managing your risks, you look for efficiencies, you look for opportunities where you have certainty and where you have perhaps an opportunity to capitalise on events that are occurring to your benefit. Looking at external issues and trends, COVID-19 is a black swan event, but that's not to say that you can't have sort of a plan for when things do turn into a crisis. Hopefully this is a 1 in a 100-year event, but it will take some time to come out of it, and everybody is quite uncertain about what the next 18 months to 2 years will look like. And just finally, business recovery. Business models, long-term goals. Again, this is reiterating what Michael highlighted earlier. Understanding where you're at, what your risk appetite is, but also looking at restructuring, disposal, mergers and acquisitions. There are always lessons to be learned, and there's always opportunities to use technology and the new sort of resources that have become more widespread and commonly utilised throughout this crisis. So we have a resource hub available. There's a whole bunch of publicly available documents that you can read through. And with that, I'd like to hand back to Michael for questions.
Thank you, Eleanor.
Thank you, Michael.
No troubles.
I'll jump in quickly. Yeah, we've just had a couple come through, and if anybody online still has one to ask, you can use the question toolbar, and any we can't get through now, we'll ensure one of our OF experts gets in touch within the next 24 hours. Going on into more probably a functional question, Michael, we've had come through is just what the process is around registering your business with OFX. What does that involve?
Sure. So for businesses looking to register, the process is a relatively straightforward one. Just visit ofx.com. There is a register tab on our homepage. There is some basic company information that we would request as part of that process. And then someone from the OFX team will be in contact with you relatively quickly. There is just a small form post that online application which would need to be filled in. But the majority of our business accounts are set up within 1 to 2 business days.
Great, thank you. We also just had a question around adding multiple users to managing their account within the business and whether that was possible.
Yes, it is. So we do have what we call organisational capability for business accounts, which means that different users can be authorised for different levels of instruction. So whether you wanted to set someone up who can add new recipients versus a user who was to book in deals, and you could, in that example, overarch that with someone who can actually authorise certain steps of the payment process as well. So we do have a few different levels of access which is available on a primary account.
Great, thank you, Michael. And maybe just one last one, given the time, but a question around actually accessing the products and how people do that. Can they do that online? Do they have to speak to somebody?
Typically, the way products work is that they would need to be enabled by an OFX representative. So again, if you were to call someone on the team, we would simply be able to enable things like forward exchange contracts and limit orders. And in terms of your usage, yes, they can be accessed. They can be accessed online once they have been enabled.
Wonderful. Well, I think that's probably all we have time for now. A recording of today's session will be sent to participants and people that weren't able to make it as well.
Fantastic. Thank you, Stephanie, and thank you, Eleanor. Very much again appreciate your dialogue today and your involvement as well. For everybody that obviously does want to be in contact, we'd naturally love to hear from you. So please visit ofx.com. You can contact us also via email address, corporate@ofx.com, or equally, if you did want to get in touch with Eleanor or the CPA of Australia, again, contact details are available to you, policy.advocacy@cpaaustralia.com.au. Thanks again, everybody.